If you look at modern Japan, it will probably be very hard to believe that for more than 30 years, the economy of this country has been stagnant. And the Japanese themselves call this period in history the lost 30 years. And in this video, I would like to tell the story of the financial crisis that led to this situation and the consequences of which the Japanese still cannot overcome. In the 80s, the Japanese economy rapidly conquered the markets of the USA and Europe. Of course, each product had certain unique advantages, but speaking in general, the success of Japanese products was based on three main principles. Japanese products were innovative, high quality, and at the same time cheaper than similar products produced in Western countries. Let's take the car market. Now, there's a fairly popular point of view that Japanese cars began to gain popularity in the USA during the 1973 oil crisis, when fuel shortages forced Americans to reconsider their habits, and instead of voracious cars of their own production, they began to choose cheaper Japanese ones. However, this was only part of the truth. In fact, the conquest of Western markets was a joint strategy of the Japanese government and private manufacturers. For its part, the government actively subsidized exporting manufacturers, forced banks to lend to export-oriented industries, and maintained the yen at a low level against the US dollar and other Western currencies. And it was these incentives that allowed Japanese goods to be cheaper on the American market. At the same time, manufacturers who wanted to receive such state support were obliged to maintain the quality of the cars they produced and constantly work on their improvement. A very illustrative example here was the introduction of the unique Toyota production system management system, which allowed cars to be produced faster and more efficiently, to introduce innovations, and most importantly, to reduce the number of production defects. And it was thanks to this system that the small and more flexible Toyota began to oust the then leader General Motors from the market. If in the 80s GM had 750,000 employees and produced 8 million cars, then Toyota, having only 65,000 employees, produced 4.5 million cars. That is, GM's production per employee was 10 cars per year, while Toyota produced almost 70 cars per employee. And in fact, a similar situation occurred in many other industries. If we talk about the home appliance market, then the Japanese had no equal in innovation. The CD player, VCR, LCD TV, digital camera, this is far from a complete list of commercially innovative products that quickly gained popularity in Western countries. And although this popularity of Japanese home appliances did not have a serious impact on trade between countries at that time, it significantly influenced the formation of the Made in Japan brand in American society. When this brand became iconic, it aroused American interest in Japanese companies themselves. Because when Americans like a brand or product, they usually want to buy shares in that company too. The only problem was that the Japanese stock market was closed to foreign investors. Therefore, American investors were looking at the Japanese stock market like hungry wolves, waiting for an opportunity to enter this promising market. This opportunity appeared in the early 80s. Since then, no one had any doubt that the Japanese economy would soon overtake the US economy and become the world leader. Such a prospect naturally frightened the American elite. First of all, it threatened to lose economic leadership. Americans were also afraid that competition with Japan would destroy entire industries, which in turn would lead to a loss of technological leadership, and they could not allow this to happen. In addition, the problem of the trade deficit was becoming increasingly obvious, as well as the fact that Japan had become the largest creditor of the United States. Therefore, in order to somehow cool the Japanese economy, the US government took a number of measures. First, the United States and Japan reached an agreement to abolish capital controls and fully liberalize financial markets. All this was done in order to increase the flow of foreign financial capital into Japan, and then these dollars would increase the value of the Japanese yen. And this in turn would reduce the competitiveness of Japanese exports. Let me show you an example. If a Toyota costs 2.5 million yen, then at the then market rate of 250 yen per dollar, it would cost $10,000 in the US. If the yen rate rises to 100 yen per dollar, the price of the car will rise to $20,000. However, Foreign currency flows cannot always increase the domestic currency rate, because the central bank could easily buy up excess currency into its own reserves. And therefore, to prevent such a policy of the central bank, the Americans forced the Japanese to sign the Plaza Accord in 1985, according to which Japan was obliged to strengthen the yen against the dollar and a number of European currencies, and it was this agreement that became the trigger for American investors, because it was possible to earn not only on the growth of shares of Japanese companies, but also on the rate itself. Well, imagine. In 1985, the Japanese currency was 254 yen to the US dollar. Let's say you have $1,000. You exchange them for 250,000 Japanese yen, and you can buy either local securities or real estate, even if asset prices do not change. And in 1988, if you had 250,000 yen, you could exchange them for dollars at an exchange rate of 125 yen to the dollar. And you can buy 2 million US dollars for 250,000 yen, a double increase, out of thin air and only because Japan was forced to sign this agreement. And in a few years, American money drove the Japanese stock market to unprecedented heights. The Nikkei 225 index grew from 10,000 in 1984 to 39,000 in 1989. Stock prices were growing faster than company profits. Investors were buying the prospect. The weighted average PE ratio for the Nikkei index was 70, while the figure of 30 in the USA was already considered high. But we are talking about an innovative economy that will soon conquer the whole world, so investors were ready to overpay for shares of Japanese companies. The only problem was that such an increase in the Japanese yen hit Japanese exports very hard, because it led to an increase in prices for Japanese goods in the USA, and this, in turn, significantly reduced exports and company profits. And for the export-oriented economy of Japan, this was a very serious blow. In turn, when Japanese companies began to show more modest results than expected from them, this led to a sell-off of shares, which provoked a collapse in stock prices. The Nikkei index fell to 7,000 and has not returned to the level of 1989 even today, and the Japanese economy itself faced a protracted crisis, which in 10 years would be called the Lost Decade, later the 20s, and now they are called the Lost 30.